In the early 18th century, Isaac Newton was the most analytically sophisticated human being alive. He invented calculus, mapped the orbits of planets with exact precision, and defined the laws of motion that governed the physical universe. Yet, in 1720, he lost the modern equivalent of £3 million. Newton fell for a straightforward stock scam, a company with no mechanism to deliver the massive returns it promised its investors. Calculating the orbits of planets provided no defense against the irrationality of a market frenzy. To see how a fraud of this scale takes root, we have to look at the crisis gripping Britain in 1710. A decade of fighting the War of the Spanish Succession had left the government drowning in £10 million of debt. The interest payments alone were consuming a massive portion of the nation's total revenue, leaving the government desperate for a solution to balance its books. This animation illustrates the solution proposed by the South Sea Company. They offered to absorb the national debt by allowing creditors to swap their government debt bonds for equity shares in the new enterprise. Investors expected limitless wealth from South American trade, but the Treaty of Utrecht severely restricted the company's rights. They were limited to supplying enslaved people and sending exactly one ship of general goods per year. The massive gap between the company's actual rights and its unlimited promises was the core lie that enabled the crisis. The company's directors prioritized political access and financial policy over actual overseas trade. By 1719, they expanded the operation, pitching a plan to absorb the entire £31 million British national debt using newly issued shares. This circular flowchart tracks their logic. High share prices were needed to fund the massive government fee. To maintain them, directors fabricated rumors of non-existent treasure fleets. With no actual revenue, the system required constant new investor money, a textbook Ponzi scheme. To keep this loop running, directors engaged in severe market manipulation, lending investors money to buy shares while using those exact same shares as collateral for the loans. This chart shows how Isaac Newton initially approached the stock. He analyzed the situation, bought in early, and exited with a rational profit of £7,000. But after he sold, he had to watch the share price continue to skyrocket uncontrollably without him. As his peers grew unimaginably wealthy, Newton faced an intense atmosphere of social pressure and mounting regret. Abandoning math for emotion, he bought back into the company with £22,000 near the absolute peak of the mania. When informed insiders quietly sold their holdings, the resulting panic crashed the price from over £1,000 down to just £150. Regret and social pressure proved stronger than Newton's mathematical discipline. The collapse wiped out thousands of investors. Newton personally lost £20,000, and contemporary engravings capture the chaos and desperation of the ruined public. Government investigations quickly exposed a massive trail of falsified records, secret share issuances, and extensive bribes paid to senior officials. Parliament responded with the Bubble Act of 1720. This legislation targeted the specific speculative mechanisms that fueled the crisis, recorded in annuity documents like this one. The disclosure requirements and insider trading laws we rely on today trace their intellectual lineage directly back to this specific disaster. 3 centuries of evolving laws have followed, yet the exact same speculative cycle repeats itself continuously. During the dot-com bubble of 2000, highly intelligent people convinced themselves that standard economic rules no longer applied to the new internet economy. The 2008 housing crisis mirrored the South Sea playbook perfectly, relying on collateralized lending and the assumption of perpetual price increases. The cryptocurrency cycles of 2017 and 2022 serve as the latest iterations of this unbroken psychological pattern. While we can regulate the mechanics of a fraud, human emotion remains outside the reach of the law. If the man who calculated the orbits of planets couldn't outsmart a bubble, the true danger to any investor is their own psychology.